Right, so welcome to today's podcast. It's the 9th of March 2020, and this is Adrian Boothie here, Head of Trading at Trend Signal, and I'm joined with Jerry Miller.
Morning.
It's a good morning. It's not a good morning for everybody. The markets are absolutely melting at the moment. There's a price war kicking off between Russia and the Saudis, and I guess the US, I suppose, and also this little thing called Covid-19 continues to hit the markets. But we're going to be getting all into that today. It's going to be a break from the usual format because, like last week, there's just too much going on at the moment. So let's just bring some charts in. And Jerry, why don't you kick us off with what's going on?
What's going on? The markets are completely melting on the back of what initially you might have thought was coronavirus news, and that the spread of that is escalating, especially in Italy. They've basically quarantined 16 million of their population, roughly a quarter. Lombardy and Veneto, the cities like Milan, Venice, all cut off. But actually the real news over the weekend, and it brewed up from last Thursday with the OPEC meeting in Vienna, they were attempting to cut production by about 1.5 million barrels a day. They didn't achieve it. Oil, as a consequence, fell 10% on Friday, $4 on Friday. And I thought that was quite a move.
By any measure, that's a pretty... I mean, you look at the ATR the day before that, you got to say $2 ATR, and then it fell $5. So it fell 2.5 times its normal range of a day.
You only have to look at the size of the candle on Friday and compare it to the previous sort of couple of months, and you can see it's by far and away the biggest. Wow. But then the news that it's a little bit of a maverick reaction, but the Saudis decided not only were they not going to cut production, they were going to increase production. Not only were they going to do that, they were going to discount their prices.
And they were the ones trying to hold off on cut it or more,
Okay, they're in a unique position. The three big producers in the world are the US, now the biggest, thanks to shale oil, Saudi, obviously, and Russia. Now, Saudi produces their oil. They've got the cheapest production costs, so they've got the least to lose in a way.
Why it's just easier fields? They have to suck it out of the rock as much as
they don't have to go to some ghastly frozen part of Russia to pick it up, and it's just in the middle of the desert in their back door, and they literally put a hole in the ground and up it comes. So it's not deep water, it's not shale oil, which is a complex sort of production, and the shale oil industry will struggle now because they've never really made profits, so they've got short of cash and all that sort of stuff. So really,
that's what it's about, isn't it? So Russia having a real bee in their bonnet that actually it's holding back production has done nothing more than actually strengthen the US oil market.
Well, that's exactly what has done. I mean, the US producers will be rubbing their hands together, seeing more production cuts, but down at $35. What's this on Brent? That's a big move. It has overnight. Yeah,
31. I can see down here on my chart, and then US crude to NYMEX crude, which is the non-Middle Eastern crude, but that's been down as low in the 27s. Nearly 32 now. It's
sort of more of a domestic oil, the US oil, the WTI, but it still follows world oil, and it's just the most extraordinary move going. We were talking before we came on air, as it were, and back in the Gulf War, the market had spiked up, and everyone thought at the start of the Gulf War, where the US was taking on Iraq, they thought all hell would break loose, but of course it's such a one-sided affair. Within the matter of a day or two, it was over, and the price of oil absolutely collapsed. So it's trading at $29-30 a barrel. Wow, imagine that. Well, it's sort of near where we are today.
We haven't gone anywhere.
But it used to be sort of $15-20 a barrel, and then to see it jump up was pretty frightening. But then it just collapsed. Extraordinary. And I was reminded of that when I read the reports in the FT. But these are big moves, and obviously it's hitting. As you were looking at the BP chart earlier on, all the oils. But there are benefits. I mean, a lot of people are going to benefit. Haulage, logistics, filling up at the petrol station. I worked out if oil is 40% of the component of petrol and diesel, and it's come off 30%, that could be, it works out at about 14p a litre.
Yeah. Doesn't sound a lot though, does it? There's so much tax in there.
Well, that's because oil is only 40% of the price of the products, because a lot of it is, as you just said, is taxes.
So the biggest stocks are being affected. So one of the reasons why I say the FTSE is down so much, we've got two really big components, or at least they used to be really big components in BP and Shell. Very heavy in resources, and they're taking a big hit. So BP's down about 18% today. One thing I want to actually get across today is, they might in 6 months' time, you might look at now and think, oh, bargains and so on. Just be careful because the markets could carry on further. We went limit down in the US today, and it's only, I think the last time we went limit down in the States was 2008, wasn't it?
Financial crisis.
Yeah. 12 years ago. It doesn't happen very often. I think you just got to just be a little bit cautious, and if you are going to be buying stock and stuff, then just make sure you keep the risk down too low. One of the problems we see is a lot of people just see this and they just go in all guns blazing, and it has the propensity, the danger to take you to the cleaners, really. So just be careful.
Really. Worth explaining what limit down means. That the US markets and certainly the UK markets will take their cue where the US is from their futures market, which is their regulated markets. And what these markets have is a circuit breaker. So if the market falls too far, they prevent it going below a certain price. And the first circuit breaker is at 5%. So at 5% down, the market can't trade any lower than that. And if you look at the chart
it's got to go back above in an auction and to then go back down again, isn't it?
No. What can happen is it's offered limit down at 5%. You want to buy it, you can pay the offer, you can trade it there, you can buy as much as you want at the limit offer, and it will actually bob out. If you look at a 5-minute chart on the Dow, for example, you can see it happening. So it's been limit down, but it's actually traded up as it went out of limit. And that's as the other markets started to react higher as well. So it's not been stuck at limit the whole time. It's come out again, but it's now coming back down again.
Yeah. Interesting. I mean, the market, really, there's been some fantastic moves on the DAX. If I just look at the dynamic trader strategies, some amazing moves this morning on that one. Because there is no limit down there, so this is actually continued to be a tradable market. Fantastic sell at sort of 6:44 if you're up that early, but lovely sell trade there, and really interesting couple of continuation buys. There's some fantastic volatility. Just got to be mindful of some of the concerns, really. And look, actually, we're in a short right now. We're in a sell from the close of this bar, up about 60 pips on it at the moment. So really good moves, to be honest.
Yeah, it's probably worth noting as well, when the US is locked at limit down, what we've just described a couple of minutes ago, if anyone wants to hedge their US positions, guess what they'll do?
They're going to be trading the other indices so they can get their grubby mitts on.
They will be selling the DAX and the FTSE. That's not the US markets, but if you're panicking and you need to get some cover on board, you'll do it. And that's the reason why the DAX was off, or the GER 30 as we referred to it here, was off 8.5%.
Yeah.
Way more than the US. Not because anything's particularly more wrong with Germany than the US, it's because of that.
Okay, so what about these other markets? We've seen the likes of gold has been quite impacted of late, weirdly as well. We talked about it in last Monday's session, didn't we?
Yeah, it is one of those lightning rod sort of safe haven markets, but it's behaved quite sort of interestingly, because remember it's been rallying quite sharply since the sort of late December. It's gone up huge, and it's sort of, there's a lot built into the price, and I think when funds have been hit for 6, as soon as there's any whiff of any profit taking, like we had the previous Friday, when the market fell from sort of 1650, at one stage it went down to sort of 1580 or something. Big moves, anything up to $100 it fell. And it's not because suddenly gold's not a safe haven, it's just because people were taking profits. Yeah. And as soon as it started to fall, it was that snowball effect. And it sort of happened last night with the gold was, it was way up to what, $30. And then it fell, just carried on falling. And literally about an hour ago, we were lower than Friday night's close. So it's actually down on the day. Odd. really.
It is odd. I mean, we've been in buy mode for quite a while. I mean, the trends have been up, so we've had that long bias. So we're buying dips in gold at the moment, and it's sort of interesting here. It's certainly not what we would expect it to be. So just to explain, just in case anyone didn't attend last week. So people are, the big funds over in the States, they've got a big loss on their index positions. They've got a big profit on their gold positions, so they're closing their gold to take profits to help their margin with the indices. Is that pretty much right?
It can help, but really the size of positions in gold is nothing like what you have in your equities. So, but anyone who's got a position, and if you're making a few, significant amount of money, even if it as a percentage of a portfolio is not that big, you're still not going to let it just go by, are you? No. So anyway, but it's going higher, but it's going in some real big volatile moves, and down big time that previous Friday, but then you remember the Tuesday last week, bang, straight back up again.
Yeah. And what about bond yields then, Jerry? What's going on there?
Okay, another safe haven when in times like this, investors rush to get out of riskier assets such as equities, and they look for the safe haven that is bonds. Bonds are where, certainly sovereign bonds, those are bonds issued by governments, you're always going to get your money back. And those are the bits of paper that people like to buy, knowing that they can get a bit of return on them and they get their money back. Whereas equities, well, you only need to see, you just showed up BP down 18.5%. You won't suffer that sort of consequence in bonds. The problem is the yields are collapsing.
So where are the yields now? They're in negative territory.
Well, they are for most European sovereign bonds. There's something like $16 trillion worth of sovereign bonds that are negative. That means you buy a bond, basically you will get less money back at maturity.
So you're better off keeping it under your mattress.
Yeah, that's fine. But if you're a hedge fund, if your hedge fund with $2.5 billion, you're gonna have to have a
big mattress.
Big mattress, yeah. But so US 10-year yields have just collapsed. So the world and his wife has been buying US bonds because they did have a yield on them. They now are below, I think 30-year yields are below 1%. So you're getting 1% per year buying US 30-year paper, holding it for 30 years, 1%. Not great.
Well, let's have a look at the interest rate situation, because the US last week came in with a sort of an emergency 50 basis point cut, didn't they?
Yeah.
I say, we talked about it last month. Well, maybe they'll come out and do something before the meeting, which is on the 18th of March. And here we are. They're pricing in another cut for the 18th of March meeting now. So do you want to tell us a bit about that, Jerry?
Yeah, it was interesting actually, because this time last week, so the day before, we were looking at this forward rate tool from the Chicago Mercantile Exchange, and they were telling us that it was implying that it was going to be a half-point cut at the next meeting, which is on the 18th of March, next Thursday or next Wednesday, one of the two. But we reckoned that we said there was a risk that they could cut intra-meeting, i.e. between meetings, and they've done just that. So last Tuesday they cut rates by 0.5%. The markets rallied, came back down again.
It wasn't much of a reaction at all. In fact, it was a reaction for about 20 minutes.
Well, to tackle coronavirus, are you really now, knowing that your mortgage or perhaps your overdraft has been cut by, let's say, 30 basis points, are you now going to rush out and risk your life to go to a football match or travel around or spend money? That's what they want people to do. It's just not going to happen, and they know that now. So what monetary policy is going to do to bolster or get us over the coronavirus epidemic, I don't know.
So what's the point of another cut?
It's psychological, and it's one of the few ways that central banks can show that they understand and sympathise with what's going on. But governments need to act. This is monetary policy, but you need fiscal policy. Yeah. But so going back to interest rates, of course, now this is showing is that now next Wednesday, the Fed are going to cut rates by a whopping 0.75%.
So it's a 75% likelihood there'll be a 0.75% cut on the 18th. So that would mean, in all likelihood, a 1.25% cut in 2-3 weeks.
In fact, see, I question whether this is actually right. It's actually implying 0 to 25. Yeah, which is a 1%.
That's a 1% cut.
Yeah. I don't think that.
Right.
They're actually most participants are saying 0.75% is possible next Wednesday.
The problem you've got is that once they do that, and then we do go into a recession, then there's no other thing else to do apart from go negative.
Yeah, I mean, I think just generally about a global recession, I think it's probably odds on now. But the question for all these economists, is it going to be a V-shaped one, i.e. go down, coronavirus fixed, back up again? Let's remove oil from the equation because I think it's a sort of an initial hit for now. And there's a lot of discussion to take place about that. But the underlying problem is the coronavirus, the Covid-19 spread, which is going to hit all economies globally. And it's going to result in a slowdown, if not a recession in global growth. Is it going to be a U-shaped, which is down, along, then up? I.e., is it going to bobble around at the bottom for a few months? I think it's probably going to be a V-shaped recession. I think if we do hit a recession in the UK, that is, but I think it's likely that we'll recover, like the global. Because a lot of stuff that we're not doing now is not something we'll never do, we're just putting it off. If you're not going on holiday, you're not ever going to go, you'll then have your holiday in November or October or I don't know.
Yeah. Yes, you're not going to not go on holiday for the next 5
Correct.
years, are you?
Correct.
You might drop one holiday this year, and that sort of thing, isn't it?
Yeah, but you'll catch up, and that's what the market will do. That's for the hospitality industry, especially in the tourism.
Okay, and I suppose we'll be talking about similar cuts elsewhere, will we?
Yeah, it's pretty. I mean, I think we've got ours on the. I say ours. The Monetary Policy Committee, the Rate Setting Committee for the Bank of England. They meet on the 26th of March. They've factored in anywhere between 1/4 and a half point cut, and there is speculation they could do something before then. So sort of like the Fed did one before their meeting, the Bank of England might do something. But sterling's had a bit of an interesting rebound though.
Yeah,
you know,
isn't it?
Because at one stage I think they were expecting some sort of emergency cut, and it all sort of petered out. But remember, this is as much a dollar move as a sterling move. In a way, looking at euro sterling is more sort of symbolic of where sterling is, and that sterling really weakened considerably the previous week, but actually it's sort of been treading ground for the last sort of 5-6 trading days. But no, I think we're going to get a cut. Are we going to get a cut in Europe? That's the big question.
Yeah, I mean, well, you're talking about maybe getting a cut to minus 0.6.
Yeah, it's nuts. That's factored in, but I know Covid-19, coronavirus, whatever we're calling it, interest rate cuts do not help the underlying issue with that. Do they help it with an economy that's slowing down like the Eurozone was? Yes, it would do. But it's difficult to know. I mean, they've got to do a lot more stuff, and I think European governments have got to do stuff, and European governments are really slow. And some of the big northern powerhouses, they need to engage in a lot more fiscal stimulus. That's cutting taxes and stuff, and not leaving everything up to the central bank.
Well, that's right. I mean, we've got we've got the budget on Wednesday in the UK, haven't we? So you know, obviously we're talking about getting the debt under control, but at the same time, you know, borrowing has never been so cheap.
Well, that's right, and
really.
I think
so. If you're going to invest and you're going to create more debt, then now's the time, really, isn't it?
I guess, and it's sort of been that way for a few years in a way, but I think they're going to rewrite some of the fiscal rules. But this chap, Rishi Sunak, has been in the job for, I don't know,
2 weeks or something, isn't it?
Well, I think it maybe 4 weeks, but it's quite tough on the guy. Now he's got presented with a backdrop of an economy that's probably, along with all the other Western economies, diving into recession.
It's quite the hospital pass, isn't it? Let's face it.
Maybe started jabbing you. Maybe it just stopped.
Yours.
I'll blame Boris, but actually, this coronavirus. Wow. Yeah.
Right. Anything else that we need to get our teeth into?
Okay. Yeah. Other stuff. The currencies, not just the dollar, but we've talked about oil collapsing. Of course, oil, not just oil. Base metals, all the resource sector has been smashed.
Yeah.
And of course, so all the miners have been smashed. There's no point looking at individual miners, but what you can do is look at the currencies where those products come from. Australia, look at the Aussie dollar.
Yeah.
Have a look at that. Now, you may not be able to see it that clearly, but there's a line, long piercing line where the market crashed to overnight.
Yeah, I mean that's about a 5% fall.
It's It is just that. It's a 5% fall, and it's down. It's one of these flash crashes where more selling cause more selling, which cause more selling. So that snowball just falling.
And in the small hours where there's no liquidity as well.
Correct. That's exactly what happened. And it recovered. Happened to the New Zealand dollar as well. So if you look at the NZD USD, you'll see the same deal there.
Yeah.
That horrible spike lower, and it's actually back to normality as well. So where it should be. But the Canadian dollar, slightly worse off. It gapped lower, or this is the number of Canadian dollars to the dollar. So this is the dollar rallying, the Canadian dollar falling. It's recovered some of its poise, but nothing like the Aussie dollar and the New Zealand dollar. So the Canadian dollar under quite a bit of pressure there. But these are all resource currencies, and you expect to see them lower on the back of the move overnight.
Yeah. I mean, there's been some massive moves on the likes of Euro CAD. I mean, obviously you've got people switching into the Euro, out of the Canadian dollar. I mean, that's just almost, it's just a ridiculous move now.
Any of the resource pairs certainly against the Euro, which has been particularly strong. And Aussie yen, CAD yen, New Zealand yen, they'll all have gone just berserk.
Well, dollar yen, I mean, we had a cracking short a few weeks ago, but 10 days ago maybe. Look at it now.
Yeah.
I mean, that's a 6% fall.
Well, it's odd on the yen because they released their GDP data for Q4 last year, and it showed that the economy had cratered, was in a horrible bad period because of the consumption tax. I think it was down 6.3%.
Yeah.
The likelihood of it being a negative quarter, this first quarter, i.e. Jan to end of March, is probably an absolute odds-on certainty.
You'd think.
So Japan is going to be in a recession. Why you be buying their currency if it's in a deep recession? It's one of the worst performing economies at the moment.
Yeah.
And its currency is one of the best performing. Work that one out. It's a safe haven thing, but people love buying the yen. And they've not forgotten it, and they still think it's a thing to do.
Old habits die hard, huh?
Yeah, there you go.
All right, so should we get on to look at the calendar? Is it worth looking at the calendar?
Well, it is, but it's not a lot. But it's just worth just mentioning a couple of things,
just
Adrian.
Get rid of a couple of these lower impact things.
That's right. So the first thing that is worth pointing out.
Do we want to look at last week actually? Because we've got non-farm last week. Is that worth having a quick look?
Yeah, it can do. I mean, it was.
It ends up being a bit of a non-event compared to everything else.
It is a non-event, but it was a lot better than expected, wasn't it? I mean, it really was.
And actually a really small reaction to it as well, because not only did they revise the previous month up, but obviously there was an extra 100,000 jobs created than expected too. So
I mean, that really surprised me. The ADP data on Wednesday didn't surprise me, but this cracking, what on earth is going on? Well, my own view is that I suspect the Bureau of Labour Statistics have muddled up their data and got it wrong. It just doesn't make sense, and I bet you the data in April's revised down. Anyway, we'll see.
Yeah.
But positive. But in the light of what's going on with everything else, the markets were never going to do that well off the back of it, were they? And they didn't. They definitely didn't.
It's funny, all these things that would normally create quite a big impact, it's just nothing.
The trouble is we're looking at data, because everything is changing so quickly, week or day by day. Looking at a lot of data, especially lagged indicators, they're irrelevant.
Yeah.
They really are irrelevant. We want to know what's going to happen in the future. It's the leading indicators that we're interested in.
So let's have a look then for the for this coming week. I'm on the wrong week. There we go.
Okay, first thing we need to just remind everyone, we've had a change in the hours in the US.
Yep.
So it's daylight savings. They're now in their summertime, so their clocks have gone forward. What that means is instead of being a 5-hour difference, there's a 4-hour difference. With a 4-hour difference, it means US stock markets open at 1:30. And if you trade the US market up to the close at 9 o'clock, you're going to be getting off earlier at 8 o'clock. And that's going to carry on until we change our clocks, which is on the 29th of March. So it's 3 weeks. 3 weeks of early closing, early opening, and all the data points coming out an hour earlier. So all those numbers that come out at 1:30, it's 12:30.
Yeah. I prefer that. It's when we're out of sync for 3 weeks, when we're
the other way.
It will shut at 11 or whatever. It's
that gets quite painful. Yeah, or 10.
We spring forward and we fall back.
Yeah, that's right. Yeah, but the data. Yeah, but the data this week's pretty light. We've got our budget. We've already mentioned that on Wednesday 11:30. They're saying, I don't know when he starts. I thought it was on Tuesday. I don't know what's going on.
It's Wednesday.
It is Wednesday, is it? Okay, Wednesday. And this is Rishi Sunak, so we've already mentioned him, what he's going to do. It's up for a bit of debate, but I think he's backed away from doing anything drastic on pensions and the like, so it's going to be a bit sort of neutral, really, and they're going to delay any changes in their fiscal rules until October, so he's having a budget but not having a budget, if you know what I mean. Wednesday, also US CPI, Consumer Price Index, or inflation as we like to call it. It's the core number we look at, plus 0.2%, same as last month. And honestly, Adrian, on the back of the oil price, inflation has just suddenly become so irrelevant.
Yeah.
What is the likelihood of inflation ticking up in the US over the next few months? I would
Pretty
say
minimal.
You wouldn't put any money on it, and it's not going to happen. Hence, and that's why the Fed have been cutting rates. There will be. It's just shocking what they're doing with rates, isn't it? But anyway, so inflation used to be important. It ain't important for now, that's for sure. Crude oil inventories, again, in the afternoon, that will also be irrelevant for obvious reasons.
Yeah.
Because we know what's happening in the bigger picture, and the domestic oil supplies in the US really suddenly just take a back step, as it were. The other main event this week, we've talked about it earlier on, which is the European Central Bank, then policy meeting on Thursday. They're going to let us know what they're doing with their financing rate. It's at zero. The rate at which banks charge interest or are charged interest by the central bank is going to go from minus 0.5 to minus 0.6. And that's supposed to encourage those banks to lend money to corporates and you and me. Let me think. No, that's not going to work, is it? And there's a big debate about how effective cutting rates further into negative territory, how that's going to instill confidence in businesses and in the retail market. I'd say not at all.
No.
Why the hell are you doing it in the first place? Well, things are so bad, that's why. They're really that bad. Tell you what, I'm not going to spend any money.
Yeah.
It's that sort of attitude. Anyway, the press conference at 1:30 is going to be a lively old affair because there's a lot of debate about what Christine Lagarde and her committee are going to announce. But I think QE, dollops of other monetary stimulus, policies to help businesses, all sorts of stuff.
Yeah. Okay. And one thing we've got on the sort of medium impact, we're talking about leading indicators.
Yeah.
Is this something that's suddenly going to be a bit more interesting on Friday, the consumer sentiment from the University of Michigan?
Yeah, that's something that I always wonder why it's not higher impact, because it's a great leading indicator and it provides good insight into what is going to happen in the months ahead. And already you're seeing a figure of 101 in February. Now we're looking for consensuses for 95. I think it's going to be going down in the months to come, for sure, surely. Yeah. And one thing that, do you know what affects consumers a lot in the US? It's the value of their 401ks.
Absolutely,
their pensions.
Yeah. And
I tell you what, with the markets we will have fallen 20% by close of play tonight if the markets close where they are. And if they do, I tell you what, people won't go and spend money.
No, because they're seeing it. You know, it's interesting when people, because a 401k, if you don't know, it's all to do with the pension funds, the private pensions in the US. They don't have a state pension in the States, so they all invest in, a lot of them invest their own pension, their IRAs and their 401ks. Now, the problem with that, in a way, is that we talk about all BP's falling and this is falling, that's falling, but we don't see the value of our state pension, so a lot of people don't see the impact that it then has, because we just...
You get a letter once a year, don't you?
Yeah, exactly. Yeah. Whereas in the States, when they're more active with it, they're seeing it on a day-to-day basis. And they're logged in, they're trading it, they're looking at it, and they're able to look at it, which we're not with the state pension, which means that suddenly it just has a real impact on their positivity or negativity.
Yeah, whether they're going to spend any money or not. Ironically,
it's a big difference, huge difference across...
ironically, that's not for now anyway, but it affects their thought processes.
Well, you're thinking about your plans into your retirement. What can you afford now? Oh God! And suddenly it's a negative, isn't it?
Well, mind you,
that's all it is.
Maybe some astute people will be thinking, I'm not going to spend any money. I'm going to put it into the stock market. This is an opportunity. Yeah. Every time the market has these big banana skins over the last sort of 40 years, 30 years, they always recover. And I've been around watching it long enough to know that exactly is what will happen. The question you have to ask yourself: has it got a lot more further to fall?
Or how long is it going to take to recover?
Yeah, that's right.
Where are we on the V or the U?
That's right.
Are we at the bottom?
I mean,
or
if
are we halfway down?
Yeah, if you're 65 or 66 and you're just about to retire, you're not going to be too chuffed with this sort of move. Of course, as someone who's about to retire, you shouldn't have had that much money in the stock market anyway, because you wouldn't want to risk that much. But these are all the questions that people ask. But very interesting markets, and the VIX, which is something that we tend to look at as well. I'm just surprised, Adrian, how it hasn't really gone up much. I would have expected to have hit 50. Last time I looked, it was about 42.
I think it has got up as high as that.
42, yeah.
Well, you've gone into the 50s in the small hours, 54 in the small hours on the cash VIX.
Well, then I'd ask the question, why has it come down so much? But there you go. So
when the markets hold sideways, it does come. It just doesn't stay up here, does it? It's one of those.
When I looked at it, when I got in this morning at about 7:30, it already come up. It was back down. I was thinking, God, I honestly thought it'd be well above 50. There we go. But
I think actually, we can get data going back to 1990. I think the only time it's been above 50 is 2008.
Great financial crisis. Yeah.
So I think it just doesn't really do it for some reason.
And I'm not sure that data is spot on either, because I remember volatility is getting up to sort of 85%.
Yeah.
Which basically means the probability of everything happening.
Yeah.
All your puts and all your calls could all got an equal chance of being in the
Who knows?
Yeah,
Who knows
that's
what's
sort
going
of
on?
it, really. Yeah.
Okay. Well, anything else to add, or should we shut up shop?
We could talk forever, Adrian. To be honest,
probably could.
I'm not sure someone wants to hear me whittering on about everything in detail, but a lot. It's a very moving target. The coronavirus is still the underlying issue why the markets are so weak. I have a feeling the oil issue will stabilise eventually, but the question is whether oil comes back up, however much it comes back up or not. It's when this Covid-19 really starts to spread in earnest in the likes of the US and Northern Europe.
Yeah.
It's something that will pass, but it may take 3 or 4 months, and the impact, we're not altogether sure what it's going to be, but judging by the way some of these countries are behaving, like in Italy, what a bad thing to do. I think it's good to quarantine all of those regions, that's Lombardy and Veneto, the 16 million people, but they told them they were going to do it, and for about half a day everyone got on a train and went down south to Puglia. So I wouldn't be that happy if I lived in southern Italy with all my northern brethren's
breathing on you,
coming down with their virus. But anyway, it's just not been handled well there, to be honest. But there we go.
No. Well, okay, let's call it an end then, shall we? So this time next week, hopefully it'll be a little better looking next Monday. But tune in. Otherwise, have a great week's trading. Make sure you keep your wrists tight. This is not. People have a propensity to look at this like some sort of lottery ticket and bargain basement, but low is a relative term, as we've talked about in recent sessions. So
oil
just be careful.
Cheap. Yeah, oil looked cheap on Friday, didn't it, Adrian?
Yeah, absolutely it did.
And that closing price on Friday now looks quite expensive.
And it can still go down more.
Yeah.
All right, guys, have a great week. We'll catch you next time. Bye bye.